Several emails came in about a discussion I had a little bit earlier in the week on bonds. A guy called in and said he had $30,000 or $40,000 tied up in bonds, and he wasn't talking about savings bonds, although I do recommend cashing those in at all times and putting them in a good investment. But bonds as an investment category, I told him to get out of them. And then in another call, I had a lady call in that was wanting to do all kinds of different things, and I suggested to her that she invest, that she's wanting a good, safer, calmer investment, that she put her money in growth and income and balanced stock mutual funds. Balanced stock mutual funds will have some bonds in them. In a rising interest rate environment, less and less bonds and mainly large company stocks. In a declining interest rate environment, they'll go heavier into bonds. But here, let me just kind of back up on this whole bond thing for a second and just teach you guys for a little bit. To start with, you need to understand what a bond is. It's a debt instrument. If you buy a $10,000 bond, if it's a municipal bond from a city, that means that city borrowed $10,000 from you. They're in debt to you, and they pay you interest on the debt, and then they repay the debt later at the call date when the bond matures. That's what a bond is. And so if you buy a corporate bond, if a company issued bonds, they are borrowing money from you. It is a debt instrument. That's how it works. And the financial planning world has long said that if you want to lower the risk of your portfolio, move towards bonds. For instance, as you get older, that you would move away from stocks or equities and you're investing in towards bonds. I disagree with that. But see, I think independently. I don't think like everybody thinks. And I actually look at data and I actually analyze things and use critical thought. And here's my thought. If you take the bond market and plot it on a graph as it goes up and goes down, and you take the stock market and plot it on a graph as it goes up and it goes down, those mountains and those valleys, those peaks and those valleys on that graph indicate the volatility of that market over time. And if you took, say, 50 years or 75 years of the stock market, you could see how the stock market goes up and down over a period of years. And you could look at the bond market and see how it goes up and down over a period of years. Now, something that is safer would be less volatile. If it is so safe that we move an entire population as it ages out of stocks and into bonds, you would think it would be a lot less volatile. And the truth is, if you take those two graphs and you lay them over the top of each other, there's not a lot of difference. Bonds are less volatile than stocks, but not much. And they don't perform as well. The stock market has outperformed the bond market over an extended period of time. And the difference in the two, honestly, isn't spit as far as volatility. And so and the bond market doesn't perform as well as the stock market has over time as an investment for people. Now, I understand pensions play bonds and take a bond position, and I get all of that. But I'm talking about personal financial planning. To always say that you need to move to bonds as you get older is to make the assumption, and it's a bad assumption because it's incorrect data, that the bond market is substantially less volatile than the stock market, and it's simply not. It is less volatile, but not substantially less volatile. So here's what happens. You need to remember when you buy a bond, and let's just do a very basic Finance 101 class for a second. Let's buy a $10,000 bond that has a 5% interest rate. While you own that $10,000 bond, regardless of what you paid for it, it's going to pay you $500 a year, 5% of $10,000. That's what you're going to get. Now, as interest rates go up, meaning that people in the market that have money are expecting to get more money on their money because interest rates have gone up, if you buy the bond in a 5% interest rate environment, and the environment moves up, meaning the marketplace now, to attract money, 5% will no longer attract money. It now takes 6%. If prevailing interest rates go from 5% to 6%, your $10,000 bond is no longer worth $10,000 unless you hold it all the way to maturity. because the market is saying we want 6% and you only have $500 coming off of this bond. And $500, in order for that to be 6%, means I can't pay you but $8,333 for that bond. If I want to make 6% on my money, I can't pay you $10,000 for it because I'm only going to make 5% at that. I can only pay $8,300, which allows me to make my 6% that I want. So as interest rates go up, the value of your bond goes down. As interest rates go up, the value of your bond goes down because your interest doesn't change on the bond. It's a fixed amount you're receiving, and people are now demanding a better rate of return than your bond is offering, so your bond is now valued at less. And so we're talking about the long-term bond market. We're not talking about speculating. We're not talking about jumping in and out on an hourly or daily basis. I'm talking about when interest rates for mortgages, which are bond-driven, Fannie Mae bonds, when interest rates for mortgages are at 3.5 and they move to 4.5, if you're holding a Fannie Mae bond, you just lost some money, even though you haven't sold it yet. It's like owning a stock in a company and the value of the stock goes down. You just lost money. And while we were at a 3% level in long-term bond rates, mortgage rates, we're in here screaming, where the flip do you think these rates are going from here? These interest rates are going to go up. They're going to go up. And as they go up, your bond value is going to go down. Consequently, in the last 90 days, people playing around in the bond market, people that do it for a living. I've got a good friend that's a bond trader. It's what he does for a living. And he has taken a bloodbath. Just gotten hammered. Got both his eyes blacked and his nose broke. I'm telling you, it's bad. Just because of that little move, so many basis points, they call it, in the bond market. And so you guys need to understand, I don't invest in bonds ever. But I particularly don't invest in them when the market's down. Well, Dave, you just turned around and told that woman to get a balanced fund. Yeah, but that balanced fund has already moved out of bonds. They're not going to be heavy in bonds right now because they're looking at what I'm talking about at a much more sophisticated level than I just explained it. And so those two pieces of advice are not at loggerheads with each other. They're not inconsistent. So I buy good growth stock mutual funds. That's what I've said for 22 years here on the radio. I've never told you to buy bonds.